In this video we're going to cover your divide rate. So many of you will have already started going through some of the training in the back office of iMarkets Live. So you'd understand that what we need to do when setting up our signal service is actually set up at what rate do we divide against the master server in order to trade a particular account size and really ensure that we're not risking too much or not risking enough. So in this video we're going to cover that, and I've actually made a little calculator so that it's very simple for you. You can just fill in your parameters and you'll know exactly what you need to do. So if I quickly just pull up my charts and I'll show you exactly what we're talking about. If we go to the IML copier, and you can see that the divide rate is set to 1. Now the master server is putting them through in mini lots, so you have standard lots, mini lots and micro lots, and depending on the size of your account will depend on how much money you're going to risk per trade. So we know that the server's sending out a mini lot signal, which means that if we set it to 1.0, then we would be copying that and we would be trading a mini lot as well. If we want to trade 2 mini lots, then we'd set that to 2. If we want to trade a micro lot, then we'd set that to 1.1 here. And the way that would reflect in our actual account, in our actual trading, one mini lot is actually a 0.1. So if we were to place a trade with a new order, you can see if we were to put this to 0.1, that is one mini lot. Okay, if this is 1.0, that is a standard lot. If we go 0.25, for instance, that's 2.5 mini lots or 25 micro lots. Okay, so depending on, as I said, depending on the size of your account will depend on what you need to set this volume to so that you're trading an acceptable amount of money per pip, because because the way that this translates into real money is on a USD pair. Okay, so it changes for the yen, it changes for the pound, but on a USD pair that would be $2.50 per pip or close to that. So a micro lot, a 1 here, a 0.1, will cost you $1 a pip. So if we had a stop loss of, say, 10 pips, then that would cost you $10 if it went to stop. If we had a profit target of, say, 20 pips, then we would earn $20. So depending, again, on your account size, will depend on what you want this to be. So let's go and have a look at the calculator. So the way I've set it out is to make it very, very easy. So what we've got over here on the right hand side are the recent stops. Because our trade is being placed by the traders, we don't get to determine how big our stop loss is. So the best way that I thought to make sure that we at least have some idea of what it is that we should be trading, we're just going to log the most recent stops, 5 most recent stops, and that will give you an average stop size. So we're going to work with the average stop size. So you can see we've got 11 on the average stop size. If I was to change any of these, it would change the size, you can see. So if we put this back to, say, 8, we've got 11 as our average stop. We'll put that over here. Now, something that's very important and that we need to talk about is risk. It's very easy to get caught up in all the excitement and want to risk a lot more money per trade because, of course, the more you risk, the more you make. But something that I've learned from trading and something that I think is really, really important to understand is, even though you may be able to take a drawdown on your account, because that we're going to see a run of stops at some point in our trading life. Okay, it might not be big, might only be a few stops in a row. And while your account financially may be able to handle that, the real question, and what a lot of people struggle with, is the emotional impact of that. When you see a run of stops in your account and your account is having a drawdown, it can become a little bit hard to emotionally detach yourself and just let it play its course and come back up with the profits. Some people, they get upset or they get concerned that, you know, this could be the end and we're just going to have stops from here on out, which isn't the case. Of course, we see profits, we see stops. That's trading. We're going to see profits and stops on a daily basis, even perhaps. So you need to set your risk to a level that not only can your account handle the drawdown, but you can also handle it emotionally. Now, you'll find all sorts of opinions on this and how much you should set your risk to in your account. I personally, trading for myself, set my risk to 1% per trade. So for every $1,000 in my account, I risk $10 per trade. Okay, so if I have a stop out and I have a $1,000 balance and I have a stop out for me trading personally, I'll still have $990 in there. Now you can see that's really quite conservative, and what it means is that you're not riding some emotional roller coaster in between stops and profits. You need to be able to place a trade. I know these trades are going to be placed for us, but even still, you need to be able to set up your signal service and not worry whether or not you have a stop or a profit that night. You don't want to have to wake up and rush to the computer and be like, oh my God, we had a stop out, look what we've lost. If you are worried about having a loss, then you have your risk too high. If you can't sleep because of the trades that you have running, then you have your risk too high. You need to reduce it to a level that you are completely impartial on the result, and you know that over the long term, you're going to see steady growth. And that is what 1% does for me. You'll find a lot of other traders will be happy to stick around 2%. I know some very successful traders that don't trade more than half of 1%. So you just need to decide this for yourself. I'm recommending 1%. If your account's small and you want to get some things moving, you can go to 2%, but please don't go any higher than that. If you go to, say, 10%, you'll be risking, as I said, 10% of your account each trade. Now, 10 stops in a row set up like this would clear out your account. That is just far too risky, and it's far too hard to control emotionally. So please just be sensible, be a little bit conservative, and just make sure that you set your risk to an acceptable level. Once you've set your risk and you've got your account balance in here, this can obviously be whatever you like. Maybe you're starting with $500. Maybe you're starting with $5,000. It doesn't matter, but I'm going to put it in at $1,000. We've got a 1% risk. We've got our stop from the average of the most recent stops, and this gives us our volume. So at 1%, with the 11 pip stop on a $1,000 balance, we were risking $10 for the trade, which is a 0.09 volume. So as we were talking before, if that was a 0.1, that would be $1 per pip, but it's a 0.09 obviously because there's 11, so we need that extra one, which brings it up to the $10 mark. So let's say that our stops change and all of a sudden our stops are 20 pips big, then you can see the volume changes. Now I know I'm focusing a lot on risk, and of course we're intending to make a really good profit with this business, and I expect to, but you just need to understand the risk component of it. Okay, the first and foremost is account preservation. We don't want to lose any money, and if we are losing money, we want to make sure it's in small increments compared to our account balance so that we can handle it emotionally. And then we start to earn money, and over time our account balance will increase, and you can see that gradual building effect of the FX market. It's a beautiful market. I'm sure you're all going to be very excited with it. So once you understand what your volume is, the divide rate's very simple. This divide rate shows you exactly what you need to enter into your parameters in order to be trading a 0.05 volume. You would need to trade a 0.5 in your copier. So we'll come in here and I'll show you this again. So right here, the divide rate, if we were trying to trade that volume that we've just discussed, then we would be a 0.5. 0.5. And that would mean that we were trading 50 cents per pip, which is exactly what we want to do according to the calculator. 50 cents per pip times 20 pips stop would charge us $10 for a stop out, which is 1% of our entire balance. Obviously, stops are only part of the story. We're going to make profits. We might see a 40 pip profit. That's a $20 profit for this $1,000 balance, which is a 2% gain. So you just need to understand the risk component, and then the profits are just magnified on top of that. So just to run through it quickly again, Put in your recent stops, that will give you a number. Come over here, enter your starting amount. Let's say you've got 1500. Your risk, perhaps you can go with 2%. Your stop losses, we're down at 11. That gives us our volume. That gives us the amount that we're going to be risking per trade, because obviously the stops, they vary, so every so often it's going to vary from this amount. But just to give you an idea so you can monitor your account to make sure you are in the ballpark of what we're trying to achieve here. It also gives you the divide rate. So you can see here, with such a small stop risking the 2% and the slightly larger account balance, we're actually trading 2.7 mini lots, which gives us a divide rate of 2.7. So if we pull up the charts again, here, where this used to say 1, we're now going to have 2.7. And that means for every pip that the master server trades, which charges $1 per pip on a USD pair, more for the yen, more for some of the other pairs, your account will be trading $2.70 per pip. So I hope I made that very clear. I hope you all understand how to use the calculator. To me, this is an absolutely fundamental part of trading. Okay, please take this on board. Make sure that you are conservative in your approach with trading. This isn't a money game. This is a real business, and you need to understand what it is that we're trying to do here. You need to be able to take the emotional side of the drawdowns, because this industry, particularly when you're new, you really just need to be nice and conservative, and as I said, just let that account grow nice and slowly, particularly while you're learning.